In this video, I want to walk through Lemonade's shareholder letter for Q3 2022. So let's dive into it, give a little bit of my commentary. I've also done some modeling and updating of my Lemonade model. So we'll take a little bit of a peek at that. I'm not fully done that yet, but we'll take a look there as well. So let's look at the letter first and give some of my thoughts as we go through. So strong quarter for growth. I mean, in-force premium still up 70% year over year, so huge growth there again. 609 million in-force premium per customer up significantly as well, and number of customers. I mean, I think they got about 100,000 customers from the Metro Mile acquisition. It was in that range, and they added 196,000 customers in the quarter. So it still added about 90-some thousand customers just organically or outside of, not organically, but outside of the Metro Mile acquisition. So this is a really bad number, and even why the stock fell immediately after hours, I'm sure is a big part of it, is this 94% gross loss ratio. So it was kind of trending upwards, the loss ratio, and here we go. Or trending downwards, I should say, overall, but now we're shooting back up to 94%, and they do talk about that right away here. They call weathering the storm. They blame two things. First of all, the Metro Mile acquisition, which they're saying adds 3 to 5 percentage points to our loss ratios for the next few quarters, which is something we should have some more commentary on tomorrow morning at the call, because it's one of the top upvoted questions was my question about the integration of Metro Mile staff data and tech going. And also, Daniel, he had said in an interview that the main issue with Metro Mile's loss ratio is waiting for regulators to approve a rate change. So basically admitting in an interview with Emmett and Matt of Good Soil, basically saying, yeah, the loss ratio is bad because the pricing is not high enough. So we have to raise the pricing, but we're waiting for approval from regulators for that. So hopefully get some more commentary on that, and that could at least be part of that 3 to 5%, and when that could be changing or even moving in the opposite direction to improve the gross loss ratio. But then they also talk about this catastrophic event and being Hurricane Ian, one of the deadliest hurricanes to hit Florida since 1935. I'm a little bit unsure about that. And I'll bring it up here. A tweet I made back in September saying, will Hurricane Ian affect Lemonade? Not majorly, as Lemonade doesn't offer home insurance in Florida yet, only renters, pet, and life. Also in South Carolina, they only offer pet and life at this time. So, and when somebody, a financial controller here, did comment, I have had renters in Florida for almost a year. Ian may add a couple of points to the loss ratio in the local situation on the West Coast. I assume he's talking about forest fires there. Is quite bad. Expect headwinds in the loss ratio this quarter, maybe not as bad as Q1 2021. So he was right on the money there from October 1st. And they talk about making hay while the sun shines. Well, Q3, there tends to be more people looking for insurance, so they spent more marketing in that quarter than they would in Q4, which does actually fit in line with my model, because after accounting for customer churn, I had acquisition cost per customer in Q3 of $110 per customer, while it was $225, $230, $250, $175, in some of the previous quarters in the last year and a half. So certainly more efficient per customer, probably because there's more people moving around, transient sort of people going to school, that sort of thing, that need renters insurance, and also those sort of customers looking for renters insurance, that type of product, are probably easier to acquire, less competitive market to compete in for acquisition costs. And then they talk about how they're going to slow down growth, this miles per gallon, as as they don't want to have to raise more money because the valuation's so low right now. So really trying to work with the cash they have available, that they're actually going to slow growth way down from, the 76% of in-force premium growth now. They're expecting 20 to 25% annual growth. So you can expect the next year, 2023 full year guidance that will come out next quarter is going to be much more conservative. And I'll walk through that here in a minute in my model, but I've really tapered down my growth for at least the next 2 years. Then we have the Chewy partnership, and they really don't tell us much here. I really hope in the call tomorrow we get more information about the Chewy partnership, because they are giving up 5% equity for this partnership. So what kind of growth can we expect? Should we expect? And we should hear more because it's one of the top voted say questions. It says how much growth should we expect to see from Chewy partnership? So we should hear some more about this, and I'm sure some of the other analysts might even ask on the call about the partnership. Hopefully we hear more details. And then, of course, they have a small note about launching basically a similar product to renters insurance in the UK, and Investor Day that's coming up next week, which I will be at, and I'll be doing a video or discussing a little bit more what I'm expecting from Investor Day probably this upcoming weekend. Annual dollar retention was at 84%, 2% increase, so it's a tiny increase there. We'll be looking at how I calculate the churn from ADR and from premium per customer and number of customers. So I'll look at that here in a moment in my spreadsheet. And total operating expenses almost $110 million, which they have talked about. They have been talking about for the last several quarters that this quarter they expect to be peak losses. So this should be peak losses. That's what I'm trying to model in my own model. That is the corner's starting to be turned. It better be, or we're gonna have, there's gonna be major problems. And really, as we'll see here in my model in a moment, Lemonade really has to go nuclear on their costs. They have to go nuclear and be as lean as they possibly can. Some of these costs as a percentage of gross earned premium just seem outrageous, and they should trend down over time. They have to be for them to be successful. So let's take a look at my spreadsheet now. This is my Lemonade model. The whole thing is available on my Patreon if you want to look at it yourselves and see it be updated real time. Feel free to support the channel, join in the Patreon. But as you can see, we've had about 76% year-over-year growth, and it's trended in the 70s, 80s, even above 100% growth. And now now they're suggesting it's going to be 20, 25% kind of going forward. So I've really tightened down the customer growth quarter over quarter. Next 2 years, I'm kind of really tightening up the growth and saying customers are almost flat. Maybe they barely are growing the customer base, but there's still a lot, as you'll see in a second, there's a lot of customers that are still churning given the type of business they are, the type of customers they have. So I'm suggesting that they're barely going to break even. This might even go negative. Then I'm suggesting the existing customers, more of them are going to get older, and the premium per customer will increase as the ones that stick around and don't churn tend to buy more products. So I'm increasing that by more like 4.5% quarter over quarter, and that gets you your year over year in-force premium by next year of about 24%, and then 24% the next year. And then I start to slowly ramp it up again up to 34%, 45%, 50, in that kind of 40-50% range going forward there. After that, I'm suggesting gross loss ratio bounces back to kind of where they were. Hopefully they get the Metro Mile pricing figured out here soon, and that starts to affect their loss ratios, and they get more into that 80%, 75% range, then 74%, even 73% the next few years. And then looking at ADR, so annual dollar retention was 84%. From that, you can calculate about 500,000 customers, or 38% of the company from 12 months prior left the company. So if you account for those customers that they had to make up for that churned, then your sales and marketing, which was $35.8 million for the quarter, works out to about $110 per customer that was acquired. And that's about 26% of your gross earned premium. So again, they really have to cut these down. I'm saying next quarter, I'm assuming because the customer growth, I'm assuming that they're still going to have about $110 per customer, but because the customer growth is so small, then your sales and marketing really drops down significantly. So they're spending a lot less money on sales and marketing to get that small amount of customer growth that they're hoping for. Then other insurance expenses, I have these flatlined next quarter and then slowly growing over the next couple years. Tech development, again, have this flat line for next year and before slowly ramping, a little bit of cost added to it then after that. G&A, general and administrative, there's huge, $40 million. That would jump from, it's an 81% quarter over quarter increase. Massive expense here. 30% of all their gross earned premium is just general G&A. So I don't know. I assume a lot of this has to do with the Metro Mile acquisition costs related to that, a lot of the staff and people you bring in related to that. And given some of their losses, projected losses for next quarter, I'm assuming a lot of those expenses are still going to be there. And then I'm assuming they're going to have to lay off people, cut expenses, and I'm trimming this down by 20% down, then 10% down, so we get to 29 million, and then it's holding there for all of next year. Kind of before this jump where they were closer to, they were at 28 million, then 22, bouncing around a little bit. So I'm putting it there and then slowly increasing it in 2025. And again, so then it's 27% down to all the way down to 15% of your gross earned premium. And then total expenses, again, we're at 81% of total expenses as a fraction of gross earned premium. That's obviously not sustainable, but I have that tapered down next year into 61% and then to 52 to 44%. And then slowly tapering down. Eventually, I'm going to have that hitting about 15% right now by later into like the year 2030 and beyond. So what does this all mean? It does mean that I have profitability happening later. At least right now, I had it more like in the year 2025. But now I've pushed it back into more like 2027 just because their growth is slowing down. So it's kind of delaying or pushing back until you reach that inflection point and you have enough customers with enough premium per customer and enough products and enough markets to really take off. So I've pushed that back a couple of years. Doesn't mean still can't be successful. Doesn't mean the stock couldn't even be successful before then. If the market started to see that profitability was coming, that could still happen. But that's kind of where I have it, at least right now. Obviously, this is a moving target. Things could change, and this could move sooner or later. I have a really rough market cap calculation. Again, this could really broaden out into the future, really change. But by late, by 2035, I have in the $80 billion to $140 billion range. And of course, that would keep even growing past that. So still a massive, massive upside. It's just sort of like the potential for that upside, if successful, I think is a little bit delayed because the growth is going to be so slowed down for at least, hard to say how long, but maybe the next year, 2 years, maybe even longer. Expenses, you can see as a percent of gross earned premium, will slowly drop over time to that 15% range. Cash, we hold very, very steady, drops down here, drops all the way down to like $700 billion range before turning that corner in the 2027 kind of range and coming back up. Cash requirement, I have slowly dropping, which is a function of how much cash they have minus what the cash they need to hold, what cash requirement they need to have in order to meet their reinsurance structuring requirements. So right now, with where their reinsurance is structured right now, it's more like a 3-to-1 cash or in-force premium to cash is what they kind of need to hold. And so this is sort of the amount they need to hold, and is slowly dropping. And then I have here in 2027, I still had this in my previous model as well, that somewhere they have to restructure their reinsurance and take on more reinsurance so that they, or they'll need to raise more capital, maybe if the stock jumps way up in price before then. One of the two, but in this case, I have reinsurance being increased so that the amount of cash they need to hold decreases. And then as their cash catches up versus the amount of in-force premium they have, then this really takes off. And it's somewhere later on in here they could, again, drop their reinsurance if they wanted to. But overall, I'd say this quarter we're on track. It's not really surprising anything from the quarter thus far. It'll be really interesting to hear more commentary from management tomorrow morning, and if there's some more really interesting stuff there, I could do another video pointing out any of those sort of details that come up. Again, if you want to support my channel and see this whole model yourselves, please consider joining my Patreon. I want to mention as well, I'm going to be at the Lemonade Investor Day, and I'm covering as much as I can that day, and of course after that day. So really excited and looking forward to that. But also in my last video, which I'll bring up right here, if you haven't seen this video, I encourage you to see it. It says one graph you won't see on Lemonade's earnings. And in that video, I showed a graph where I calculated the customer retention over time for different cohorts inside of Lemonade. And then what I've been doing since then and kind of realized was possible was that I tweeted about it here. I said, you know what, if you extrapolate these curves to 0, so if you figure out, when does this curve, how many quarters does it stretch out to before it goes all the way down to 0? And then I said, if you take the area under that curve, so if you assume, all the customers that joined the cohort, this blue cohort in Q3 of 2018, you look at all those customers and they slowly phase out over time, you could add up the area of that curve to kind of get an amount of applicable quarters that a customer is actually paying for their for insurance from that cohort. And then you could kind of take that and multiply by the premium per customer for each quarter in time that stretches all the way out, and add all of those premiums up, multiplied by the percent of each one, and you would get kind of a rough percentage of in-force premium for that cohort of customers. And of course, you could get a gross earned premium from that by multiplying by, I've been using about a 23% average. So you could get your gross earned premium of the entire lifetime potential gross earned premium of each cohort. And then you could model that out based on how the equation how you extrapolate one curve out, you could model that out for various curves that are slowly increasing in value and stretch out further over time. And that's what I started doing. And I'm going to present that in another video here, and also present that to you soon. So stay tuned for that video. I did some kind of crazy math, going to organize it a little bit better here, but the results are quite interesting. Anyways, that was a lot of information to throw at you guys, but hopefully you got some value out of it. Thank you so much for watching. Please let me know in the comments what you thought of this quarter, and love to hear from you. And please remember, it's in the bag.